Hello and welcome. Allow me to start this presentation off with a question. Are you prepared for another lost decade? Hello, my name is Murray Halprin. This is the first in what we hope are many presentations of our new Safe Income Strategy videos. These are designed to help you get thinking about how risk-free capital preservation can fit into your investments and your portfolio. So let's get started. Have you ever heard of a lost decade? Well, let me read it to you. Here's the definition. A lost decade refers to an extended period, typically 10 or more years, during which equity markets produce flat or negative nominal returns. Investors who bought and held through these periods often saw their portfolios stagnate or decline, even before accounting for inflation. On a real inflation-adjusted basis, the impact is often more severe for investors. So let's explore the decades of the past and try to compare them to our current situation and see if we can find any parallels. Major lost decades. Here's some history that has recorded some major lost decades. You and I have heard about all of these growing up. Our parents talked about how difficult the times were between 1929 and 1954. They called it the Great Depression era. And during the Great Depression era, it took 25 years for the Dow to recover. That's a long time. So an investor that bought the Dow near the highs in 1929 did not recover until 1954. Not too long after that, we had 1966 to 1982. That's been tagged the stagflation era. For 16 years, the Dow moved within a broad range, generally between 600 and 1,000, amid terrible oil shocks, high inflation. I remember I was young during those early years, but I remember in the late 70s, I think interest rates went up to around 21%. Real inflation-adjusted terms, the losses were substantially worse, with purchasing power declining sharply. Sustained gains did not emerge until inflation eased in the early 1980s. Let's move on. We all remember this one, 2000, turn of the century, to 2013, the double dip period. I didn't even know it was called that. Two major downturns occurred during this period, the dot-com bust and the 2008 financial crisis. These events left the Dow lower in the early 2013s than it was at the start of the millennium. So let's take another view of these periods, but let's put it on a larger perspective, go to 100-year perspective. Personally, when I looked at this chart, I found it remarkable how well the equity markets have recovered and performed during these past 100 years. The issue we are going to hone in on is for those of us who are in, or let's say 10 years from retirement, are you willing or will you be able to withstand a lost decade or a market crash for all of your portfolio? Remember, many of these lost decades were just big consolidation periods ready to push this market higher. And if you have the staying power and the time, well, maybe it's worth staying in and buying into those. That's your decision. I couldn't make that decision. But I think for somebody who's in retirement, near retirement, or worried about their whole portfolio, you might want to move some of the money out of there for protection. So let's kind of explore a little more. What are some of the key reasons for the lost decades? Let's see if some of these reasons can compare to what we're going and seeing today. Let's start with the first one there, elevated valuations and market concentration. Well, you can argue, I can argue, we can all argue. Certainly, the valuations in today's market are elevated. And concentration, I don't think we've ever seen more concentration. The Dow, the S&P, the NASDAQ, they've all been moving basically with under 10 stocks pushing them. So we've got far more concentration and far more elevated valuations than many times in the past. Systemic debt and banking crisis. Well, I don't see a banking crisis right now that I've read about, but certainly debt from consumers is starting to pile on. And that becomes a problem with purchasing power as we move forward. And as they're piling debt on with these higher interest rates, it's creating an issue that could create a crisis as we move forward. Stagflation and energy stocks. Well, we certainly don't have stagflation yet. We currently are experience a bout of inflation. Who knows how long that's going to run? Right now, it all depends what happens in the energy markets. And I'm going to caution everything right now. Keep your eye on the weather this growing season for grains. And that could be a key indicator for all of us. If we have a bad crop market, a bad corn, soybeans, wheat this summer, watch out for inflation. That's a tip from me, just my own personal opinion. But the energy shocks now are reflecting what we saw in the 70s, and we saw what happened to the markets after that. Policy and regulatory factors. Well, there's always going to be policy and regulatory factors that change, so keep our eyes on that one. No, we're not in a Great Depression, but the Great Depression did change everything moving forward. And of course, when we have these market downturns or stagflation or eruptions in inflation, it changes behavioral aspects for everyone. We decided to take this and look at it through that 100-year period of lost within the lost decades. And what we found out during the past 100 years, 54 of those years fell within the lost decade periods. And so basically, 50% of the years were good, 50% of the years were, I'm going to say, sideways or not good, which created terrible returns during most of those years when the market was going sideways and down. We've had a great run up here basically since 2008. That's when all this really began after that big bust in the market. And at some point, it's going to get exhausted. Who knows when? I certainly don't. But maybe it is time to siphon some money out, prevent yourself getting caught in a big downturn or another lost decade. Now, I want to explain, I'm not a pundit, a financial planner, a stockbroker, portfolio manager. We don't do any of those things, and I certainly am not suggesting that I do. But I have been around a while. We do sell insurance products that protect your cash assets. And I'm following some very smart people out there who have created measures to help determine when markets might be ready for a correction or consolidation. One such indicator is by a guy we all know, Warren Buffett. It's called the Buffett indicator, which compares U.S. stock market capitalization with GDP. As of June of 2026, the Buffett indicator stood at around 237%. Now, this is a level that is dramatically elevated to long-term history. In fact, the historical average that I could find is between 100 and 110. While no valuation can tell you when things are going to happen, it's certainly being used as an indicator that the market might be overbought. Another such indicator is called the S&P 500 Shiller-Cape ratio. Now, like the Buffett indicator, as of 2026 May, the Shiller-Cape ratio is near 39.5, 40-ish, right in that level. Current average is, like I said, 40 to 42. The historical average for this is 17.36. Now, reading into that, you could say this is dramatically elevated compared to the market. Does that mean anything immediately is going to happen? No, I can't tell you that this is going to create any corrections, but it's worth using what other smart people and companies have put together that's worth taking a peek at. Thought we would share that with you because that goes into our theory here. What if you have all these great profits in your portfolio, or you have cash laying around and you want to secure some extra money for your future? Do you want to leave that in the markets and keep going? And if you're 55, 60, you're already in retirement at 65 and older, you might want to think twice about that. So what you're seeing on the screen here, this is actually one of my company's annuity calculators. And what I told this to do is I said, let's solve for how much money for two people, joint owners, a husband and a wife, for instance, and they want to add in their retirement years, they want to secure an additional $5,000 a month for the as long as the one of these people lives. The current age of the oldest person was 60, and they want to have that extra 5,000 when they hit 70. So on this income for life annuity, their premium, one-time premium, would be $359, 281 cents. Now, there's a lot of details to this, and this is just an example. I'm not telling you exactly this is what it's going to be, but it will secure an additional $5,000 a month. And if you're interested in learning more about that, we'll tell you how to find out how it works. So, income for life on a fixed index annuity is one way to uh, uh, take this money, secure it, still your money after the a period of a withdrawal period. After that, you wanted to cash it in, you can get whatever the cash value is back. Let's move on to another type of an annuity because we're running long. This annuity, for example, if you want to cash in an IRA, a Roth IRA, or a 401k, you might have some withdrawal penalties and you might have some taxes due on this. This annuity provides a bonus, as among other things, and I'm just going to highlight the bonus. So let's assume $100,000 initial premium. Within 3 years, this annuity is going to give you a compounded bonus of 24.9%. So after the third anniversary, your cash value should be at least $124,860 in this annuity. It could be higher depending on what happens to the market. So if you'd like to learn more about what I just talked about, or really dig into what could help you save capital, keep your portfolio going intact. Your stockbroker is not offering you these products. Your financial planner won't talk to you about them because they don't want to lose the money. I think it's time that we look into it. To learn more and to get a hold of me, you can just take a picture of that QR code, or you can call me at 561-393-3770, or email me at murrayh@useeinsurance.com. I want to thank you for taking this 13 to 15 minutes of your day to listen what we have to say. Stay tuned for more of our videos. Have a wonderful day, and thank you very much. Take care.